Hi YouTube, this is the DIY Investing Guy channel here. I'm Callum, and in today's video I'm going to be going through the company Trainline and whether now is the time to invest. If you're new to the channel, can you just subscribe to the channel and smash that like button to get this, help this channel grow and help the YouTube algorithm, because it loves it when you smash that like button. There will be a link to a Freetrade account in the description of this video. So if you want to sign up to a Freetrade account, start investing, deposit £1 and get a share worth up to £200. Now today I'm going to be talking about the company Trainline. It's currently had a bit of a pullback in the last few weeks or so, and obviously there's there's a reason for that. There's a government-backed rival being created and I've got an article from Yahoo Finance that I'll go through on that in a minute with you. As you can see, at 17th of May it was about $4.36 a share, and now it's lost over 30% of its value, and it's all about $2.71. Now this is the sort of time that I'd be looking at a company that's on my watch list. It's been on my watch list for a while. It was on my watch list even before Rona, and obviously the whole of 2020. And purely because I've used this service before, and it's a pretty good service. I booked some train tickets to Liverpool. It was easy, it took me 5 minutes, and I got a decent price on it. Obviously, I never got to go on the trip to Liverpool, but I got a refund for the tickets because of obviously all the world events that were happening last year, and they did give me a refund of the tickets. So it's a pretty good app. It's a pretty good service, but obviously there's more to a company than just how the app works. And if the service is great, it's about the financials and the fundamentals of the business. I did like the fundamentals of the business and the financials before, obviously, the start of 2020. But now I'm just going to have a quick deep dive into it now, since obviously everything's been going on. Obviously things we're going to be looking up for Trainline with the economy reopening and everybody going back to work and stuff and travelling around about. But obviously after yesterday's news, the restrictions to be kept for another 4 weeks, so that's not another great news. But on the 20th of May, the government announced that they were going to have a reform of how people buy tickets, and they were going to produce their own app for people to rival sort of Trainline. But in my opinion, the government's never been that. They haven't got the app yet, so that's not a major issue at the moment. And the government's never been great with producing, making apps and stuff. As we all well know, last year they're not the most successful at making apps and running their own businesses, in my opinion. Anyway, also George Soros his UK investment arm has got a bit of a short position in Trainline. Now he famously shorted the pound in 1992, and he made $1 billion in a day on it, I think. So that's one to think about as well. But obviously we're going to go through the fundamentals and stuff for the business in a minute. Now, yeah, so it's an online travel booking platform that lets users buy rail and coach tickets throughout the UK and Europe. So it's not just based in the UK, but most of its revenue comes from the UK. Now, with the announcement that the government's obviously doing their own back thing, and it was a risk when they floated. They said this would be a risk, that if the government decided to reform the way travel tickets were brought, that it would be a risk to the business, a potential risk to the business. So obviously they might ramp up its European arm now, and that could open up massive revenue and profit for it in the future. So I'll just go to the article before we go to Simply Wall Street and have a quick look at the fundamentals. This is the article. Rail reforms will surely reroute Trainline's profit margins to head south. So meaning, take a nosedive. The new fat controller body will launch its own website and app to sell tickets, which looks a case of parking its locomotive in Trainline shed. Basically, the government's taking market share away from Trainline. The company had commanded a $2 billion valuation before Thursday. This is on the 20th of May, by the way. as those white paper, because even at current reduced passengers numbers, its ability to continue extracting 5% commissions on ticket sales had seemed assured. Soon it would have a state-backed rival preaching a gospel of efficiency, which surely means clawing back a chunk of Trainline's revenues. The shares fell by 23%. Since fell a bit more than 30%. I think the lows are about $2.50 a share. A gospel of efficiency for a government, a state-backed app is not, I don't think it's quite over a bit of an overreach there. Corporate decline is not guaranteed, since shops is also independent ticket retailers will be welcome to compete. One way or another though, Trainline's pre-pandemic profit margins of 33% must be heading south. Nice app, but the rake off is too rich. Which floated Trainline in May 2009 at 350 per share, sold its residual 12% stake in the month later. The journey was splendid and the exit perfectly timed. Private equity tends to be good on that score, but current shareholders can't say they weren't warned. Keith Williams' review, The Spine of the White Paper, was launched in 2018, and ticketing, not just the rotten franchising system, was always within its sights. The risk of derailment was not a secret, so it's been a well-known risk that it could happen. And it also shows to me this company hasn't got much of a moat, which means what's its intrinsic characteristic that keeps competition out. So Coca-Cola would have a brand moat. It's got a secret moat for its flavour. So that's why Coca-Cola's endured for so long. Whereas this company, I don't think has got much of a moat, is in terms of it's got nothing to set it away from its competitors. And competitors can obviously quite come in and take quite of its market share away. So yeah, so that's basically the be all and end all of it now. Yeah, it's $2.73 a share, and I think it's a good company, but is it worth investing in? Obviously, the first thing that I've just noticed there, it hasn't got a moat, so it hasn't got anything to keep competition out. So let's just have a look into Simply Wall Street then. And we'll go down. So earnings are forecast to grow 100% per year. Now, it's had a bit of a rough year, hasn't it, really, because it hasn't been able to make any money, and its profits and its revenues have took a nosedive already without the news of this. When there's light at the end of the tunnel for it, it just pretty much looks like it's had another setback now. So the only hope for it, really, is either the government's app being a total failure, which is a possibility. Obviously, it's not even up and running yet, and it branching out into the Europe and trying to increase its revenues outside of the UK, and it'll have to obviously fast track that and start to enhance its rollout across Europe now and stuff like that. So that's a possibility. So it could be a good turnaround play, this company, but what's the value of the company? It'll be a good turnaround play. What's the value of the company? And it's also, I'm a bit worried that it hasn't got a durable competitive advantage, a moat. So the earnings are forecast to grow 100% this year. Well, that's still a possibility because the government hasn't got the app yet, and the economy will open up eventually and people will start to be able to go out and travel. So that's still a possibility. Now, here's some two big risk analyses. Now, I don't always pay much attention to risk analyses because sometimes they can be minor, but has less than 1 year cash runway, which means it's burnt through a lot of cash in the last 12 months and it hasn't got a lot of cash on its balance sheet. And that's not really, it could go bankrupt in 12 months' time in this case, which is a big risk and big red flag. And it's had a volatile share price for the last 3 months, but that's not really an issue to me because you can buy in at cheaper prices. Let's hope for a bit more volatility and get a cheaper price, in all fairness, when it's a distressed company. Now, this is only a future company now, and that's only if things go right for it. There's no value in it. There's no dividend. The company's not healthy, which is the big one, because if it's not healthy, then it could go bankrupt. And obviously, it's not really got much past to go on, and you want a bit of past to go on, good earnings, good revenue, but proven business model of making money over a long period of time. You want that before you invest in a company sometimes. especially with when it's got no financial health and stuff like that. We'll just have a quick look now. See, 1 year return for the hospitality sector is 52%, Great Britain's 22%, and obviously Trainline's returned a minus 43%, 30% lost in the last few weeks. Obviously, it's not even been on the stock market that long, and it's had a turbulent time with the last couple of years that it's been on the stock market. Some more valuation. So the valuation, it's got nothing good for the valuations going on. It's currently, even with the 30% drop off, 67.7% overvalued. So in that terms, it was probably 100% overvalued before, and it was all based on news of the company the economy reopening, and people just overbought Trainline, and it was wasn't just frothy. It was coming over the sides of the cup. So 67%. So even with the drop back now, it's showing that it's not really a massive buying opportunity. Now, I would personally have put a small position of maybe like 1% of my portfolio, 2% of my portfolio, if it was around the £1 to 150 mark. So looking at that at the moment, I don't really think it's a screaming buy, and especially with all the other stuff we talked about, the risks of the business, obviously competition coming into the market, taking its market share away. It's a massive risk to be buying into this company, especially at the current prices. So I don't think I'll be adding this one to my portfolio at the moment, but let's carry on. Never know, we might find something in this. PE ratios in the minus 14. Price to earnings, PEG, there's none, because obviously it's got no earnings. Price to book is 4.6, isn't great. Future growth, 100%. Annual earnings growth. So if it does achieve this, then, the share price will go in the north direction, because people do like earnings. But I'd rather get it, for a good margin of safety on this, you'd want it in the, between the £1 and 150 mark, I think, because there is a lot of risks, If you buy in now and next year it's £5 a share, fair play, you made 100% on your money. But do the fundamentals, it doesn't warrant a £5 valuation at the moment with its fundamentals. As you can see from here, the revenue is dipped there, but it's forecast to go back up over the next few years. Same with the earnings. The free cash flows just took a nosedive, and the cash from operations has took a nosedive. So the free cash flow is really, it's in the minus numbers of free cash flow, which isn't great. Massive minus numbers as well, 150 million. Company's annual earnings growth is forecast to grow at 100%, and 29% for the annual revenue growth, 30%. That's pretty good. Trainline is forecast to become profitable over the next 3 years, but there's a lot of factors and risks between then and 3 years' time which could derail the business and send it bankrupt. That's just my personal opinion. All these growth numbers are great. In a perfect world, it's going to hit all these growth numbers, but now will it hit these numbers with all the new competition, with the government changing reforms in the way we buy tickets? It's and the cash problem. It's ain't got a 12-month runway of cash. Obviously, is the forecasted EPS. These are just estimates. Return on equity, 3 years, is 19%, which was good. And then here we go. Free cash flow is took a nosedive. There is no free cash flow. Cash from operations, operating expenses have stayed pretty stable, even with the nosedive. But you see that with a lot of companies over the past 12 months, really. And then return on equity, minus 32% at the moment, which is currently not great. Minus 14% on return on assets. Return on capital employed, minus 18%. It's just not. It's not looking like a great proposition at the moment. Good company, good concept, but not looking like a great. Short term, its assets and its liabilities, and its assets and its liabilities. Long term, Trainline's short term assets do not cover long term liability. And here you go, debt. The debt sort of shrunk when, the revenue started to take off in 2009. It was looking pretty good for the company, to be fair, as you can see here. it's here. It's always been quite an indebted company, but then it looked like it was turning the corner. And then obviously, through no events of its own, it's just the debt. They've obviously brought the debt down a little bit, but it's crept back up now, and the revenue has also diminished. So it's gone back in the opposite direction. So what they're hoping for is another sort of run like this to get it back up there, and then the company might look a bit healthier. And then the cash and cash equivalents, which is the main one, is, even though the cash was coming up with the revenue and the debts were coming down, but then obviously, as you've seen, it slid off. But then even the debts are creeping back up now, and the gap's getting bigger, and the cash and equivalents are running down. So it's going in the wrong direction at the moment. So it's not looking particularly great. And as you can see on here, there's a massive chunk of debt on it, and a lot of the companies I normally go through normally have no debt or only a little red slither in the corner. So there's a massive amount of debt there on the company's balance sheet. Trainline has less than a year of cash runway based on its current free cash flow. Trainline has less than a year of cash runway if free cash flow continues to reduce at historical rates of 60. Now, it probably won't now. If it's a big if things go back to normal and they do start to bring in the revenue and the cash and stuff like that, they will be able to, stem the bleeding, really, stop the blood pouring out of its business. It doesn't pay a dividend, obviously. I don't think if a company like this was paying a dividend, I'd say stay away from it. So that's basically the company. Let's see what they've been buying. So now someone's brought the shares in the last 3 months, and there was a lot of selling over the last year, to be fair. That was probably when the price was at £4.50, £5. People know, it's well overvalued insiders. So, that's why a lot of people, I wouldn't have been buying at the nearly £5 a share on the 27th of May. So one of the directors has doubled his position down on his company, that so maybe he knows something that we don't. So that may be thinking, low 250. He's brought a big chunk of the company. So in terms of the company size, and that's probably a bigger jump for him, especially if he's doubled his position. It's mainly owned by institutions, not many individual insiders, so they haven't got much skin in the game, have they, really? And public companies. But that is quite interesting that there's not much insiders that own this company, but an insider's brought £100,000 worth of the company when the prices have dipped 30% in March. So maybe he thinks that it's going to be a quick turnaround and the share price might take an upward trend, but obviously there's been a lot of selling. There's a £3 million sale there in 27th of August 2020, but I think the share price was in the £4 then. So, and these are the main holders: Bale, Gifford, T Rowe, Capital Research, Invesco, Jupiter, BlackRock. BlackRock owns everything though, doesn't it? Isn't it? So yeah, there's my analysis of the company. I'm going to say it's not. To me, it's not a buy at the moment. It's more of a turnaround company. It doesn't have much of an intrinsic moat. It's going to keep out competition in the future. What's to stop somebody else creating an app? It's not really hard to enter the market. It's very similar to Deliveroo and Just Eat. There can be a lot of players in this market, so that's a bit of a worrying one. It's not hard to start a business in this sector, and obviously the government's going to try and do it as well now. So I won't be buying this company at the moment. I think there's too much debt on the balance sheet. I think it's risky with the cash flows. Even all it takes is for train tickets not to jump up quite as quickly as we expect them to, and before you know it, they haven't got enough cash. They weren't very profitable. They weren't throwing gobs and gobs of cash off before when the revenues was decent and was going up. So I won't be investing in this company at the moment, especially at these prices. Obviously, I still think it's about, obviously Simply Wall Street thinks it's 70%, and I think personally between £1 and £1.50 would be a decent margin of safety with a company like this, because it could go to zero in the next year if things don't go its way. So yeah, I won't be investing in this company. I hope you've enjoyed the video. If you have enjoyed the video, please subscribe, help the channel grow, smash that like button, get this video out there, and have a great day. Thank you.